Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to break-even analysis. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 511 break-even analysis tab under the practice problems section. Closing this back out, we're going to go over the information to the practice problem up top, and then we will have a smaller portion of that information that we will then use to work through the practice problem. Now, the break-even point in units is going to be one of our fundamental base type of calculations that we're going to be using for break-even type of analysis, often used to project into the future, to make decisions about the future and think about, what our plan is going to be with regards to earnings in the future. What we're going to be doing is breaking our costs now down to behavior, how the costs behave, as opposed to as the normal grouping will be done on an income statement. When we think of expenses, for example, we typically group them on an income statement by what they are used for the utilities expense, the phone expense, the selling expense, general and admin expense, and whatnot, the cost of the goods sold expense. They're grouped by what they're used for. Now we're going to group them by the behavior of the cost, meaning how does the cost react to a change in sales level and volume. And that's going to really help us out to start to predict into the future. It makes it a lot more malleable for us to then think about scenarios into the future. And the break-even point is going to be our kind of our baseline for that. So when you're thinking about break-even analysis, you're starting to think about, rather than thinking about costs and expenses in terms of what they're used for, which is really great for looking at the past, because you want to know why we had those expenses in order to generate revenue. When you're thinking about the future, then you may want to break it out into a more flexible component, thinking about the expenses in terms of their behavior. Are they going to be increasing or decreasing with relation to the sales volume, or will they remain fixed? And then you can do your projection type of analysis much more easily. So let's take a look at this. We got the sales price per unit, the $75, the variable cost per unit, the $42, fixed cost $105,000. So to think about this, then you got to go, well, what does it mean to be variable costs and the fixed costs? The variable costs are those things that are going to change directly in relation to the sales volume. So if you put like an example on this, let's say you have a dinner that you're going to have, and you're going to have a sales price for the dinner. It's going to be $75 per person, and it costs $42 per person to basically set everything up and give them the meal, right? $42 per person. Therefore, as you get sales, $75, the meals will then increase with relation to the sales at the $42. And then the rent on the facilities where you're going to have this place, where you're going to have the event, is $105,000. That then would be the fixed cost, because it will not change no matter how many tickets you sell, right? You can sell anywhere from 0 tickets up to the capacity of the place that you have, and you're still going to be paying the $105,000 fixed cost for the capacity of the place in which you will have the dinner or the event. Now, as you start to apply this out in practice, you might start saying, well, the variable costs and fixed costs aren't as easily broken out as you would think. In other words, you have some costs that are going to be variable and fixed, or have some kind of combination between the two, and we're going to try to put them into either a variable cost and a fixed cost in order to make the kind of calculations that we would like to make. And even those things that you would think are pretty clearly variable versus fixed, you can make the argument that if you look at a different time frame of it, they can be either variable or fixed. In other words, if you look at the rent of facilities, then you might take a step back and say, well, yeah, but I mean, if I take a step back in my time frame, then like the next event or the next time I do something, I could then change the venue or purchase more facilities or get a smaller facility. So they are variable to the extent that if you take a step back in time, they're variable to some degree. But obviously, in the time frame that we're thinking about here, that we're making the current decision in, that's going to be basically a fixed cost. When you think about the variable costs, you can even think about that even with regards to variable costs that are fairly straightforward, like the meals that you would be purchasing for the sales that you have. Once you purchase the materials for the meals, after they have been purchased, they're somewhat fixed at that point in time, unless you're doing like a just-in-time purchasing, the meals as you go. And that's true to some degree. So there's going to be some overlay between what's going to be variable and fixed, but it's useful for us to do the best we can to break our costs into variable costs and fixed costs in order to do our analysis into the future, to think about what the break-even point would be and what the point would be if we want to get some our projected revenue or our projected profits from some type of activity. So if we can break this out, we're going to say, okay, the sales price $75, the cost per unit then $42, and then we got the fixed cost, the $105. Again, you can think about this as an event. The event, we charge $75 per ticket. It's going to cost us $42 per ticket per person, and then the venue maybe is $105,000. If you had something like that, then this is a smaller portion of our information. The standard formula will be fixed costs divided by the sales price minus the variable costs, which you can also call the contribution margin. So you might see the break-even formula phrased in the form of fixed costs divided by the sales price minus the variable costs, or you might see it fixed costs divided by the contribution margin per unit, or unit contribution margin. This concept of contribution margin is going to be something we have to just get used to after a while, because it's not something we see in financial accounting. It is something we see in in finance or in managerial type of accounting and management type of decision makings. And when you think about it, you want to start thinking about, again, your income statement, breaking it out from a normal income statement, costs there by what they're used for, to a contribution margin type of income statement, costs being broke out by their behavior as best we can do, that being by how they react to increases and decreases in sales volume. So that's what the contribution margin is going to be. If you're not familiar with that term, then just, you got to get familiar with it. It's not going to be in normal financial accounting. Very useful for managerial accounting, for finance, for future projection purposes. So we're going to take our fixed costs. That's going to be on the right-hand side. Now, we're going to break out a lot of these formulas we look at in terms of a tax table type of calculation. So obviously you can plug in your information into the formula, do your algebra on it. Notice it's useful to see it in a vertical type of fashion, to see it in a spreadsheet like you might do in a tax return. This is box 1, box 2, you're going to add up this and that, and then we can break this whole formula out in a vertical fashion. In other words, we're going to have the ending, or the column to the furthest right will show at the end of the day our numerator and our denominator that we will divide out, and then we'll do steps vertically to calculate the numerator and denominator, which will be fairly straightforward with this example, with this equation, and then we'll do that same kind of process with more complex equations as well. So the fixed cost is going to be all the way to the right-hand side, because that's going to be the numerator. Then we're going to calculate the contribution margin per unit. So the sales price minus the variable cost, the sales price per unit minus the variable cost per unit, is the contribution margin per unit. You got to start to just know that. So that's going to be the contribution margin per unit. It's calculated, so I'm going to put a colon here. I'm going to bring it to the inside to show that it's going to be a calculation inside. The sales price per unit is $75. So if we're selling our tickets, $75 per ticket. The variable cost per unit, $42. That's how much it costs for the meals and setting everything up and whatnot in the place. If we subtract those two out, the 75 minus the 42, that means we have a contribution margin per unit of $33. So $33 contribution margin per unit. Those then can be used to calculate our how many units we need to sell. So we're going to take our fixed costs, like the rent on the facilities, and we're going to divide into it the contribution margin per unit, how much we're walking away with after variable costs for each sale we make, that being $33. So if we then take the 105,000, 105 divided by the 33, we're going to say we have to sell about 3,181 of these items in order to break even, in order to get to that $105,000 to pay basically the rent on it. Now you might say, well, that's great, but I want to make a profit, right? I want to have some profit on this. Well, notice this is just a baseline type of calculation, and now we can just add the profit to it, right? If you want to make a profit, then, well, now I want the 105,000 to cover the rent, plus I want to make another 50,000 in profit. So that means I got to make, I got to sell enough tickets to get that 155,000 to pay the fixed costs and make the 50,000 profit, if I take that divided by the 33, that means we got to sell 4,696 of these things in order to get to that. Or that might be a lot for a dinner, our example of the dinner here, but you can apply that out to basically any type of business that you're considering when you're trying to consider your projections into the future. You can see how this can be really useful for the projections. If you try to use a normal kind of income statement and not a break-even analysis, then the projections into the future become a lot more complex because you're not grouping the expenses as they behave with increases and decreases to the sales volume. And so what you want to do is be able to say, hey, look, I would like to increase and decrease or project increases and decreases in the sales volume, and then get a nice, quick, easy way to consider what the bottom line effect will be on profits and how many units we need to then sell. Now, obviously, you can also take this number here. If we took this in units, 3182, and say, well, how much money will that be? Well, we're selling these things for times the sales price of $75. So the break even in dollars would be the 238,650 in terms of revenue, right? So you might be asked the break even in revenue or break even in units. The break even in units is usually what we're kind of considering. So the bottom line is, when you're thinking about financial accounting, when you're thinking about the past and trying to put together the financial statements in the format that you want to be showing them to somebody else, then you're going to be thinking about the costs and breaking out the costs in terms of what they're used for. They're used for the cost of goods sold, they're used for selling expenses, admin expenses, and grouped into what they're used for. When you're thinking about projections into the futures, possibilities of what could happen, planning on different types of scenarios that you would like to see happen in the future, you shift your thinking in terms of not categorizing expenses or costs in the format of what they are used for so much as how they behave with regards to increases and decreases in the sales volume. And that allows your mind to have a lot more flexibility to come up with ideas and thinking about different scenarios and different things that we can test out and run projections on. And the base format for that, the base calculation is going to be the break-even point. So the break-even point calculation is going to be our base calculation. And when you think about break-even analysis, the whole idea of basically breaking out these costs into variable and fixed costs is sometimes referred to as break-even analysis. So notice if you hear break-even analysis, you're thinking costs in terms of behavior, costs in terms of how they change in relation to the sales volume, and the primary calculation being the break-even point. So now we're going to go ahead and prove the break-even point by plugging this back into an income statement. Now, when we think about the income statement, we're going to be looking at an income statement in terms of what I would call a contribution margin type of income statement, as opposed to a normal type of income statement. In other words, the normal income statement typically having revenue minus expense, revenue minus cost of goods sold, for example, giving the gross profit. On a contribution margin income statement, we're going to have the revenue minus the variable costs is going to give us our contribution margin, and then we'll subtract out the fixed costs. So we'll have an income statement by behavior. So, and this is not something that's going to be reported on financial statements. It's something that would be used internally, or that you would have to build in order to make these type of projections. Why isn't it reported on financial statements typically? Because normally those are geared towards past performance to see why we had those costs in order to help to generate revenue. And so they're not really geared towards future performance, because future performance is something that's going to be analyzed by management internal to the company. So outside people like investors may want that information, but it's not a required information for normal financial type of reporting. Internal calculations, however, it'll be very useful and often will be used. So we'll have the sales then. The sales we're going to calculate as the sales price per unit. We're going to break out the calculation for sales. That was the $75 price per unit times the number of units that we're going to sell, which is going to be our break-even units. We're calculating here. The 75 times the 3,182 gives us the sales, and that would be our break-even sales number, the 238,636. Then we have the variable costs. Variable costs, we're going to calculate at the variable cost per unit, which was the 42 per unit, times the number of units, the units that we're going to sell, which is that break-even point. Once again, that'll give us the variable cost of the 133,633. If we then subtract out the contribution margin, subtract out the sales minus the variable costs, we get to the contribution margin. Note the terminology here. This is the total contribution margin, which is total sales minus total variable costs, as opposed to the contribution margin per unit, or unit contribution margin, which is the unit sales price minus the unit variable costs. Once you have the unit contribution margin, notice the 75 minus the 42, which is the 33 contribution margin per unit. Hold on a sec, 33. If we were to then multiply that times the number of units, in this case, times the 3182, we can jump right to, there's rounding, so there's a rounding difference, but we can jump right to the contribution margin, 105,000 in that case. So you can calculate the contribution margin a couple different ways. You can take calculate the total sales and the total variable costs, and then subtract them to get the contribution margin, or you can take the contribution margin per unit times the number of units. And I highly recommend doing this in Excel so you can kind of, play with these calculations a little bit more and deal with things like rounding with regards to them as well. Also note that you can have the variable costs. You have to determine that you're going to have total variable costs here versus the unit variable cost, which is that 42. Okay, so then we're going to have the fixed cost, which is the 105, and that of course means that we are at the break even, meaning we have no income or loss, because that's what we were calculating here, which was the break even point. Also note, when you look at this contribution margin income statement, the tendency is to kind of match this up to the income statement which is typically going to be the sales minus the cost of goods sold equals the gross profit, and start to think about these categories in a similar way, meaning this variable cost we start to think of as kind of like cost of goods sold, and it is kind of cost of goods sold in some ways, meaning a lot of the costs that are included in cost of goods sold, which would be things like the materials and the labor, are variable. So those things would clearly be in here, but you could have things in here that would vary that aren't in normal cost of goods sold type of calculations, such as if there's sales commission, which is in selling and admin, that would be up here too, because sales commission would change with the sales volume. So this doesn't necessarily correlate to like cost of goods sold type of information that would be on a normal income statement, because we're categorizing this by behavior, although the things related to cost of goods sold, because inventory does vary with regards to sales, would typically be a component in here. And same with the fixed costs down here. They're kind of in the same category as we would have as like selling expenses and administrative expenses. So we start to think of this as kind of selling and admin. They kind of are, because normally, again, the selling and admin expenses are generally fixed costs, like the rent on the place and salaries and whatnot, but not necessarily. There could be selling and admin expenses that are variable in nature, like I say once again with the sales, right? The sales commission. The sales commission could be something that would be selling and admin that would be up here in the variable costs because of the way it behaves with regards to the sales changes, whereas in a normal income statement, it would be down here in, selling and admin type of expenses. So you want to get just don't get mixed up with the terminology with the income statement. Kind of got to flip a switch in our mind. We're on the contribution margin income statement here.